Can you all hear me?
Yes, sir.
All right, good. I think there are only 2 candidates. It is very difficult to teach a couple of students. Anyway, it doesn't matter. We'll start. So it's 1:35 right now. So just start. So there are few ground rules, and so how many lessons you all have covered, just for me to know? So are we coming towards the end of this program, or we are still in the initial stage? Huh? Right. Okay. Few ground rules. So I guess now I have done this course for IBSL normal exams also last time. So this is also online. Lecturing is also very new thing for lecturers as well. So I think it is far better if I think only 2 students are there at the moment. If we can have an interaction, I think it is going to be very interesting to both parties. Otherwise, it is unlike lecturing in a normal physical environment. It is not very easy for both parties if you don't interact, and then both parties will feel boring. So I welcome if you all can ask questions, if you can have something to add, a discussion kind of thing. Only since there are only 2 students, I think we can do it easily. So only thing, if you are on a PC kind of a thing, you won't be able to. If you join with your mobile, I think you should be able to communicate. That's number 1. And the other thing is, with the kind of learning that we had during last season, in fact, not this course, normal exam, IBSL exam course, we also learned a couple of things. So learning from that, I intend to use, I have a prepared presentation. So it's the content would be enough. And in addition to that, I'll try to, give some kind of information in terms of videos. This is this area that we are going to cover next this week, today and next couple of days would be on portfolio management and risk. Okay, if you take normal banking environment, you may be working in a maybe operations department or a credit department. It is, but what we learn in this course is not related to any of those. It is something to do with, I think, mainly with the treasury, okay, or risk management department. We call it integrated risk management department, IRM. So in this course, predominantly we cover some of the things that they do. Okay, so then if you are in operations or credit or any other department, this is very new to you. So it is very difficult to imagine also what's exactly happening. But as bankers or people who are in the finance field, you need to know, you are expected to know what is happening in the entire banking sphere, or finance field itself. So it is now it's a given thing that we need to learn about all these things. But if you don't have friends, or if you don't have any idea what exactly happening in this treasury department or IRN department, it is maybe very difficult to understand, one thing, and also very difficult to explain also. So to bridge that gap, I think I have tried to search for a couple of videos. So it will give you some insights or inside information about this department, how exactly these people work, and what really they do, will be given in these videos. So then in my presentation, I'll try to explain as it is with a mental kind of a model. So then when it is applicable, I'll give these videos, run these videos, so then you can understand the real life situation. Then we can go back to our presentation again. If there are anything that not clear, we can get clarified those things. So that's how I think I am planning to move forward today and next couple of weeks. Are we done? Clear? Okay. Viruni and Sevan, the only, I think you are the only two people that you involved in this lesson today. So if you all can, let me know if you understand, if you ask, if I ask questions, stop and ask questions to get your interaction. If you can unmute and answer those questions, I think that would be interesting. Okay, that is number one. So with that, I think let's move on to the today's lesson. Like I said, it's all about portfolio management and risk management. So this is what during next couple of weeks, including today, this is what we are trying to cover in this course. So basically, so bank and treasury department, I told you now what is the main function of a commercial bank. If any of you can answer this, you can have a dialogue there. What is the main function? Sevandi? What is the main function? That is taking deposits, okay, from general public and give them as loans to those people who really need, and in fact those who may be engaged in business. That's the kind of a intermediary role which is performed by a commercial bank. Okay, so that's the main function. So for lending to happen, what do you all need in the first place? I said we need to mobilize deposits. So in addition to that, so if there are any gaps in funding, I think somebody has to look into that. Okay, so if since we in the normal course of business, we accept deposits. If a depositor comes to the bank, in any way, if you are unable to give that deposit back, I think as a commercial bank, that's we are in trouble. So that will can in fact spread across the financial industry as well. So in that sense, I think role of treasury department in a bank is very critical. I think these are the people that mainly responsible for managing the liquidity position of the bank. So if they fail to plan and organize the funding which is required by the bank in the first place, I think it is very difficult for a bank to perform. So that's the main role done by the treasury department. In addition to that, what they exactly do will learn in few minutes time. And then so what's the main role of the treasury department. They are the main responsible to people to manage the liquidity of the bank. And then we'll learn about basic concepts in fund management. Okay, so how they raise funds. So what are then we learn about some of the tools that they use to raise funds. So if maybe you heard of treasury bills, treasury bonds, some of the fixed income fixed income tools, we learn about them. So what are the key aspects of them? Some of the technical aspects of bonds and treasury bills. So I think next week we'll learn to calculate the price of how to determine the price of bond on a treasury bill. So those are some of the things that we plan to learn. So then again, fixed income, for examples, you learn treasury bills and treasury bonds. So equity fund management, moment we say equity fund management, what comes to your mind? Can one of you tell me? Equity management, so what comes to your mind? I think it should be stock exchange. I think through stock exchange, there are buyers and sellers. Those who want to invest in companies, company shares, they need to come to the stock exchange. Maybe they can link up with stock exchange online and do transaction. Now the facilities and the infrastructure, IT systems are there to accommodate that. What I really wanted you all to remember, moment equity, another thing that go hand in hand is the stock market. Okay, then we learn some of the basic concepts of equity fund management, like fixed income tools. We then learn about equity or stock exchange also. Then we learn about risk management, and also about the global financial crisis that had happened in 2008, in that period, and so lessons learned from that. So those are the key areas that we are planning to learn in these 3 weeks. Right. Do you have anything to clear on this? Right, Binuri and Sevandi. On now another person join, I guess. So only 4 of you, no? Right. So only 2 people are there. So I saw another person added. So I was very happy, but to see that only 2 of you are there still. Right. Anyway, I was told there are about 25 people have registered every week. This is the kind of attendance. So maybe you all 2 are very keen to study. So not to disappoint you all, I think we need to learn very good, important, very significant things next couple of weeks. So now, if you take the bank and the normal commercial organization, there are, I think, a couple of differences. If you take bank, in fact, it is regulated, very much regulated. Who is the regulator of commercial banks or finance sector? Who is the regulator? Very simple question. Sorry?
CBS.
CBS, Central Bank is the regulator. If you take any other commercial organizations, like maybe can say John Keel's, or maybe Haley's, those organizations and banks or finance sector, one of the main key difference is the controls, or the regulator controlling these financial organizations, right? So if you take John Cales or Haley's, there are no controls other than they have their own board of directors. They manage, they control. But in banks, in addition to the board of directors, there is a independent body. Even it is independent from the government also. It is central bank is run very much independently. So that independent body is regulating the financial sector. So in particular the commercial banks, because the reason is the banks and the finance sector, they take deposits from the general public. So if they don't control, there can be some other repercussions, which can be negative to the day-to-day life of general public, because they give their deposits. If there is no one to represent general public, banks run as a commercial organizations. It is driven by profit. So although they accept deposits, there can be certain situations where their depositors money run into risk. So that is the reason why we have a regulator who is in fact above above all, even above the board of directors, and monitor the proceedings of all the commercial banks and registered finance companies. I think government is right now very keen on managing non-financial, non-bank finance sector. Central bank is doing exceptional work in regulating the commercial banks, but you'd have noticed that there were a couple of hiccups here and there, downfalls, where the finance first, and I think before that EETI, and long before Selinco, some of these subsidiary companies were actually gone into trouble. So because of that, government, in particular this government, is very keen to have a very methodical, very very structured approach to regulate non-bank financial institutions also. I think that will come soon. So like central bank regulating the commercial banks, there will be a mechanism to control or regulate in very much closely the finance companies as well. So as of now, it's not that's kind of developing, but soon that will happen. You know the difference now. You know the difference between normal commercial organization and very much regulated environment of finance sector, in particular commercial banks. So if you take normal commercial bank or any other bank, so this is the kind of a structure. There are so many other departments, but the credit, treasury, operations, legal, these are some of the main departments in a commercial bank. So this is just to give you an idea of what's the structure. So again, the importance of treasury department is that treasury head is in fact reporting directly to the CEO. So that's the kind of importance, because the decisions, some of the decisions taken by the treasury department is very very important for the existence of the organization. So there should be quick decisions, and so that the treasury head need the some kind of insights or consultation of CEO very often. So there can't be any other way of doing it. So that is the one important thing of running a treasury department. So now let's learn about some of the key functions of treasury. Okay, so one of the main functions is they are dealing with foreign exchange and money market dealing. Okay, so there are so many transactions that happen in lending. You can have kind of rupee loans that you give to customers, and also there can be situations, BOI companies you need to give some foreign denominated loans as well, US dollar loans. So in that case, you need to have foreign currency, flow of foreign currency also into the organization. So you need funds in both the local currency and foreign currency. So treasury is the main department which deals with these two currencies. So like I said, they need to find the exact quantum of funding which is required to manage the liquidity of the bank. So that is one of the things. So it could be rupee or foreign currencies. Then again, they are the authorized people that dealing with securities. Securities in the sense mainly treasury bonds and treasury bills. Some of the excess funds are invested in, are expected to invest in treasury bills and treasury bonds. So for better to manage liquidity in a better manner. So we'll learn about these things, how the risk, liquidity management is taking place in a bank. For the moment, just remember that treasury is the responsible body or department that is responsible for dealing with treasury bonds and treasury bills. Then in addition to these normal standard assets like treasury bonds and treasury bills, there are so many other derivatives that bank is dealing with. For an example, let's assume that you are going to import a vehicle. Okay, uh, let's say you have a vehicle to be imported from Japan. So let's say doctor, they get duty free. For duty free, they can import a vehicle. Okay, so when they import a vehicle, what do they have to do first? In importing, what is the method or mechanism that take place importing? Okay, you need to open an LC, no, letter of credit. So first of all, you need to open an LC. So that's how then the exporter, one who actually sending the vehicle from Japan, get the confidence that he will get his money. Okay, so you open an LC. So after a while, maybe a couple of weeks time, your vehicle come into Sri Lanka. So then the how are you going to make the payment to Japanese party? You need to pay in Sri Lankan rupees or foreign currency. How are you going to pay? You need to pay in foreign currency. Okay, so then that you need, and what you need to understand is the banks are basically dealing with foreign currencies as well. So when you deal with foreign currency, let's say now today the dollar to Sri Lankan rupee exchange rate is 185. Okay, so we never know due to the situation in country, when your vehicle comes to Sri Lanka, Sri Lankan port, what would be the exchange rate? It could be, now let's say your vehicle is worth 100,000 US dollars. So anyway, if you pay today, that is 185 into 100,000. Okay, let's say now after maybe 2 months, when the vehicle arrives, if the exchange rate in Sri Lanka is 195, you need to make another additional 10 rupees into 100,000. That's exactly about 10 lakhs. Additional 10 lakhs you will lose or you are expected to pay additionally for this exchange rate difference. Okay, to minimize that, so mitigate that risk, you sometimes customers are asked for forward contracts. So forward contracts, in the sense, now today is 185. Looking at the bank trends, bank can give a forward rate, maybe 187 rupees. So then 187, they expect to give accept this LC, make the payment 187 rupees. For that, they customers have to make a premium payment in front, upfront. So that's kind of a derivative forward contract. So these are some of the forward contracts and other product that is developed by finance sector, banks. So these are some of the products that the treasury is getting involved. So now a few things that treasury get in fact involved: foreign currency, and also getting foreign currency loans and Sri Lankan rupee funding into the banking system, and then dealing with treasury bills, treasury bonds, and derivatives like forward contracts and things like that. And while you are listening, I think if you have additional things that I tell, you all can take few notes as well, so that when you study, it could be useful. So another, I spoke about this forward contracts. There are so many other derivatives as well. Some of the examples for derivatives are swaps, forward contracts, futures, then options. These are some of the derivatives, the options. These are very much available in developed countries, but not so much in Sri Lanka. So in the introduction, I spoke of when I discuss about the program content, course content. The last thing I discussed was financial crisis in 2008, global financial crisis. So Sri Lanka was not much affected by the global financial crisis, whereas developed countries, particularly USA, got badly hit, because so global financial crisis was mainly actually that was originated by a derivative. Okay, some of the derivatives developed by financial sector. So these derivatives are very much available in developed countries, so they have that exposure and they got it. Whereas Sri Lanka, by nature, we are risk averse people. We didn't get involved in this derivatives, and we're not into that derivatives market. So because of that, we didn't have an exposure. So as a result, we were less affected during that time. Okay, and so another thing that treasury is mainly involved in liquidity management. Okay, so they need to make sure the funding, both currencies, foreign currencies as well as Sri Lankan rupees, regularly coming into the banking system, so that any of the depositors are not disappointed. Okay, so if that happens, then not only the treasury department, bank also in trouble. Can one of you tell what is the committee in the bank that mainly responsible for handling or managing the liquidity? What are the committees that know you in a bank? Dinero sehuandi? Do you know some of the committees in the bank? Have you heard of credit committee? Credit committee is the committee mainly responsible for approving some of the big loans, right? Big credit exposures are approved at credit committee level. So have you heard of another committee called ALCO? ALCO is ALCO stands for AL, Assets. L is Liability Committee, Asset Liability Committee. So that Asset Liability Committee is the main body within the bank which is responsible for managing the liquidity. They also set the price of deposits, loans, and also they look at what the funding requirement of the bank. So ALCO is actually for ALCO to take decisions. Treasury is the one. Treasury department is the one who is providing the much needed information, trends in pricing, so the funding gaps in different time bands, maybe. So what is the cash flow situation in maybe next month, next quarter, next 6 months, next 1 year? So that kind of a cash flow forecasting system is available in the Treasury Department. They need to provide that information to the ALCO. And also when decide the prices, deposits, and the lending, they need to provide the money market rates, what is available, prevailing rates in the market, and also the competitor situation. What is the rate of loans and deposits of commercial banks, Sampath Bank, HNB? They need to provide those information together with the market rates. So then the ALCO committee decide whether to keep the interest rates unchanged for next month or need some changes. So if the markets rates are coming down, you need to revise the rates. You need to revise and reduce the rates. Otherwise, you are not going to be competitive. Okay, so if the loans, going rate at other commercial banks 10%, if you are offering at 12%, nobody will come to us, right? So then and there, we need to take that decision. Right. Then the statutory reserve requirement management, SRR, we say SRR. Can one of you tell me what is SRR? What is the meaning of SRR? We'll learn about it. Sorry? SRR is now of the deposits that customers place in a bank, a certain percentage of that should be kept in the central bank. Okay. So during the COVID period, I think one of the things that government under government influence, central bank has done was they have reduced the SRR. It was before COVID, it was something like 7%. Now it's hovering around 4%. Okay, there is about 3%, about 100% reduction in SRR. So when banks reduce the SRR, so they have so much of money to lend. Okay, which otherwise need to be kept in the central bank without any income. So now by allowing the banks to keep it within the banking system, their funding level go ups. We say it that creates some liquidity improvement in the banking system, because otherwise that need to be kept in the central bank now without any income generating activity. So now SRR, since government has reduced that to 4%, I think banks have some kind of a excess liquidity position. So we have discussed the other one. Another role that bank has to do is to make sure they are not running into liquidity issues. They need to focus cash flow management, local and foreign currency. So what's the expected inflows, what's the expected outflows, and things like that. So uh, so can anyone say, for an example, what are the cash inflows methods from which cash come into the system or banks, and cash going out of the system? Can you just give me an example for each? One of the ways cash coming into system, when customers deposit money, that comes to the system, no? That cash inflow. Then give me an example, cash going out of the system or bank.
Lending.
Yes, when a bank lend, that goes out of the system. Some of the other examples would be when customers repay the loan, again cash come into the system, right? So when customers withdraw their deposits, then cash going out of the system. So if it is Sri Lanka local currency, it's local currency cash inflow and outflow. If the loan is foreign denominated or US dollar loan, that's cash going out of bank in foreign currency. Similarly, if it is a foreign currency deposits, it comes into the system in foreign currency. So both in terms of local currency as well as foreign currency, so Treasury Department need to have a forecast and need to manage that cash flow situation. So we have already discussed how asset and liability management takes place. There is we discussed about a committee, asset liability committee, managing this aspect. Do you have anything to clarify from what we have discussed? Any questions? If not, it is not something that we know each other. You are on the other side. I'm here. We have not seen each other. Don't feel shy. You can ask any question, right? This is the best way of improving your confidence. Ask a question. So it's always good to make mistakes and learn rather than keep silent, right? Silence suggests that you have understood everything. So let's move on. So now I told in the beginning, it's if at all any particular department that is related to our area of study is Treasury Department. So, if you take in a branch, you have a structure where your branch manager, then if there is someone to look after operations, maybe operations manager, there can be credit side, another assistant manager, overlooking credit. So there can be a marketing guy who is looking after business promotion and customer relationship. That's the kind of a when we say a bank, that's something that comes to our mind. But so it is very something that we don't know what is happening in some other department. some other very important departments like treasury. So they have their structure is, like I said, their head is head of treasury, who is directly reporting to the CEO, and there are certain situations is very responsible officer in the bank who is reporting to the board of directors, or certain things they direct. Some board of members can ask questions from the treasury head as well. So in treasury, I think there are three main subsections. One is front office, second one is middle office, then back office. So front office, like in our branches, front office, what does front office do in a bank, in a branch? What they do? What do they do? They are more into what? They are more into generating business or customer relationship, right? So they are the ones who bring business to the bank. Likewise, in treasury also, uh, the main department who is engaged in bringing business is the front office. They are the people who deal with the other side of the maybe customers, those who money dealers, those who buy and sell foreign currency, other securities. They are dealing with different parties. Outside external interaction is with front office, like our front office in a branch. And there again, there is another section called middle office, and then back office function. So we'll next we'll learn about each of these subsections, subheads, areas, what their key functions would be. The next slide, I guess. Right. So in fact, this treasury departments, front office, in fact, they are more of a profit center. They need to, what is the difference between, we need to learn about what are the profit centers and cost centers. You have any idea about what are profit center and cost center? Or else, can you give me an example of what are the other profit centers and cost centers in any organization? Profit center is where you have where buying and selling happening. Okay, so where you have the uh, uh, income generation, also you have costs. Okay, if you take a branch, they sell loan products. Okay, and they earn interest income, and there is expense also. When you accept deposit, you need to pay interest to the depositors. Then there is expense, and then again staff costs, the maintenance costs, rent. Then branch actually runs as a profit center. Okay, so likewise, treasury front office also runs as a profit center. Okay, because they have this business generating activity, so they have their incomes, they have their expenses. So then they have in banking terms, they have a KPI for profits also. Okay, so what are the cost centers that you know in the bank? So legal department, operations department, they don't generate any income, right? They have costs, so that then the head office give them a target to run particular department with X number of staff members, right? Your volume of activities are this much, so then you need to have 5 people. So next year you run with 5 people. So if there is any significant increase in operations, don't let us know. So then CEO will take a decision whether to increase a staff member or not. So basically they have a they are a cost center. So then they have their own limits of having number of heads. Head count is controlled by the top. So I think you have a fair idea of what the cost center is. But anyway, treasury is something that we call them, it's a profit center. So then treasury is mainly staffed by dealers, right? So branch is staffed by maybe branch manager, uh, then some of the credit officers, people who are in the front office, marketing guys. So that's how branch made up of. So if you take a treasury department, front office in particular, they have the main role is done by the dealers, senior dealers. So they are the people who work with other funding or banks and other financial institutions to raise funds and sell and buy whatever excess funds that banks generate. So they are dealers, and so probably credit officer or any other operations guy uh, can be recruited with normal qualification, maybe advanced level and maybe some banking qualifications. But uh, to appoint a dealer, you need to get a certificate, dealer certificate, uh, to to function as a dealer. It's a separate body to give that certificate. Like banking institute, there is a separate body who is giving running this in fact organization to give certificates to suitable and experienced persons, dealer certificates. So basically what I wanted to tell is so this treasury front office department is run by dealers. So then we've discussed this. They do some transactions, income generating activities, and also they have some costs. So each transaction has a cost. So then the income minus expenses is a profit. So they have their own profits targets. So then when you generate income, so you need to deal with prices. Price always sometimes can go up, and at certain times it can go down also. So that there is a price volatility is there. It can vary time to time. So need to make sure you are up on the deal for bank to make profits. Otherwise, bank will lose. So that at times bank can make losses, but dealers and the staff who work in the treasury department need to make sure they are not negligent. So maybe a sometimes situations sometimes give rise to some other losses, but treasury department need to work within their guidelines. So the front office, how it operates, I think you all have a fair idea of how it operates, I guess. So then in the middle office is very much similar to the our, I think, internal audit department, right? So so front office people, they do transactions, they work with other external organizations. So but there is a banking for treasury department, like our operational guidelines in operations or credit policy in the credit department. There is a separate guideline for treasury as well, where dealers has to comply. So let's say now maybe junior level dealer can negotiate in his own maybe to raise funds up to 100 million, maybe 500 million. Okay, so if negotiate anything over 500 million deal, he needs to get the approval of the head of the treasury. So if he violates that, if let's say assume that there is 600 million, he has negotiated without the approval of the head of treasury, then he violates that. So that there is a set guideline. So the middle office, they have that guideline. So there are series of uh, you know transactions that front office enter into. So all these transactions, like auditors, this middle office, there are maybe 4 5 people, normal bank people staff with 4 5 people, and so they go through each of the transaction and see whether they these front office people comply with the set guidelines. Maybe authority levels, whether they have exceeded. So because there is a purpose now, for them to have a kind of a limit and need to exercise that delegated authority only. So if they exceed, so they need to get the proper approval. So there's so many other guidelines that they need to uh, comply. So the central department is they are the ones who control this risk. So very much similar to the auditors. So kind of a risk controlling department. So then, what is back office function? What are the roles of a back office? So that is now front office people enter into transactions. So then these operations also we have this concept called dual control. They enter into the transactions, but the actual transaction is recording, and that transaction is implemented by another party, that is back office. Okay, then this both sides with this middle office is looking at both sides. So they see the transaction values and they see the actual the payments or receipts made. So you know they look at the documents and see whether there are any irregularities. So basically, front office enter into the transactions. Back office is the ones, the people who are in the back office, they are the ones who in fact get into do the exact transactions, right? For an example, maybe a marketing department guy negotiate a deposit, maybe 10 million deposit from a customer outside, and he goes and get the application mandate and everything complete, and they come and give it to you in the someone in the operations. So the operations people, what does they do is they do a back office function, whereas front office kind of marketing people do the transaction. So maybe the people who are in the counter do the back office transaction. So they need to keep records. They need to have these proof documents. Then they have to file everything in order. So there again, the front office. If you take the bank risks, so what are the risks normally bank faces? Can any one of you tell me? What are the main risks that bank face? You know these things, right? What are the main risks? Credit risk, you know. So what are the other risks? We are going to study these risks in detail. You know market risk. You know operational risk. You know liquidity risk. So these are the main 4 types of risks. So can one of you tell me the 4 risks? So I just mentioned. Otherwise, you feel boring and talking. So what are the main risks? Can one of you tell me? Just want to make sure that you are listening.
Credit risk,
Right. Tell me. Yeah. Go ahead. What are the other risks?
market risk,
Okay. Operations risks, liquidity risks. Okay. You need to remember those risks. Those are some major risks. So now tell me, if at all, the front office staff, okay, what is the main type of risk that they exposed to? We talked about 4 risks. What is the main type of risk that front office people exposed to? Is it credit risk or market risk?
credit risk,
I gave you 50-50 chance. It is market risk because they deal with transactions which have a market price. Okay, so interest rates, they take money from outside. They deal with interest rates. The market price can go up or down. So they are exposed to market risk. Then what is the risk type the back office people can get exposed to? Is it operational risk or liquidity risk?
liquidity risk,
It's given in this slide also.
operations.
Operational risk. Okay, right. So these are the things that you need to check on. So basically, back office, they make a transaction, right? So the anything that they probably make a mistake. Maybe in the voucher it says $1 million, but you make a you miss one zero, so it's a 100,000. So it is a huge difference, right? So that risk, it's something that maybe you are negligent or you are not experienced enough. So you that operationally do you make that mistake, okay? And that's the risk that back office people exposed to. Now you know the main departments: front office, middle office, and then back office. Then you know the main functions. Um, can any of you tell me one single thing that you got to know, that you learned today about front office, middle office, and then the back office? One single thing that you learned. One for each. Something that you struck your mind. Front office, one thing that you learned today.
They are having a market risk,
Right. Then the market risk. They run as a profit center. Okay. They are run by dealers. Right. Then what do you learn? Middle office. Something that you learn.
similar
Very
to
good.
audit department.
Right. That's right. That's what I wanted. They act as an auditor. Okay. They have the guidelines. They see whether the operations department and back office department they comply with the given guidelines. Then how about the back office department? What did you learn? What is the main thing they do? What do they? What is the main thing back office people do? They are the ones who
Operations.
do the operational part of the transaction. If there is a payment to be made, they are the people in arrange the payment. Like so in people who in the counters, if there is a pay order, so they process that pay order and give it. Okay, so something similar to that. So I think you have some understanding of treasury, the departments and their functions, some of the key departments and their functions as well. Right. So now we are moving into from the uh, kind of functional aspects to some of the theoretical aspects of what treasury department does, right? uh, Now like it says now uh, right, financial investment. Moment you say investment, another thing that you know go hand in hand, investment and what is the next thing that comes to your mind? Investment with the and the return, right? When you invest in something, you always think what is the return is going to be. So and again also you sometimes think, so if there is a return, is there a risk? Yes. So there is a risk return relationship as well. So if you take investments, most of the times risk return, there is a positive relationship. Higher the risk, higher the return, right? So if you take if you deposit in a bank FD, you get a definitely you get some interest. Okay, but if you invest in stock market, you are not sure whether you are going to get any dividends, right? But you take a risk, but the stock market price can go up unexpectedly, where you get unexpected profits. So there is a risk return. So with the this investment thing, you always, for you to invest, we call something called delayed gratification. You know, if you are to invest now, if let's say now you have 1 million, so you have you have to take a decision whether you are going to invest that 1 million in a FD, or you can sometimes you, if you have your family, with your family you can go on a foreign trip. If you know, this is not the right time to go on foreign trips, but that option is there, right? You have 1 million. If you go to maybe USA or United Kingdom, so maybe a couple of people, uh, that costs you about 1 week, that 1 million is enough. So you can entire thing you can spend, or you can decide whether you probably have to, you have to decide, yeah, I'm not going to go on this trip, I'm delaying that, I'm depositing this money, so that I can earn interest, right? So delayed gratification, then after 1 year, maybe if it is a 10% interest rate, you get that 1 million plus another 100,000. So 11, that 1 million becomes 1.1 million. If it is in share market, it could go either way. You lose the entire thing, you recover 50%, or you can even get 200%. So if the share that you invested do well in the stock market, you can sell it and convert it to rupees and cents. So what the investment is something that that you delay your gratification consumption, so that you will earn some return in the future. That's the main concept behind the investment. So there are two main types of investment. One is you can basically invest in land and property, real estate, we call it real estate. And also you can invest in the share market or securities, right? Maybe stock market, you maybe in the bonds, bills, treasury bills, treasury bonds, stocks. So whatever the way, you can invest. So if it is if you invest in stock market and real estate, there is one major difference, something that you see any difference between major difference between investing in real estate and invest in share market? How do you feel? When you invest in real estate, what do you get in return? So you have 5 million, you invest in maybe let's say 10 million. If you have 10 million, you invest in a apartment in Colombo, right? So you have something that you are going to own. You something to touch, tangible thing, no? You have a property and you can tell that everyone, I have a apartment in Colombo 7 or something like that. But and you can show it to uh, the people also, okay, something tangible. But if you invest in shares, yes, you can have a share certificate, but it is nowadays it is also electronic share certificates that you get, and you don't get but you have an investment, okay. But it's not something tangible. So that is the major difference between when you invest in real estate, where you have something to show, you own something and you can, that is physically available. But if you invest in share market, it is just a paper maybe. So nowadays there is no paper as well, it's electronic certificate, right? uh, so now so this is we still in the investment, we're discussing about investment. So if you invest in company, what you do is you go to the market and you purchase shares of that market, okay. You say when you buy shares, you get a ownership of that company, okay. If you say you have 50% of share, you have the control interest also. So if you are to manage that business on your own, you need to have at least 51% of shares. So it's share issue is, let's say now for an example, some time back, this Odell, which is owned by well-known personality, Otara. Okay, now she has actually she wanted to realize that investment what she has developed over the years. And what she did was she has uh, done a IPO, initial public offering. So she has valued the business and divided that into they put it that into Colombo Stock Exchange, and then public started buying the shares, okay. And then ultimately I think now that Odell is owned by SoftLogic company. So I think one giant investor called Patirana, I think Nima Patirana, he has the highest number of shares. So that's how, if you really want to raise money, you can do a public offering and call for other people to bid for it, and you get that money to run that business, okay. Similarly, if you want to buy a property, so you can apply for a mortgage loan, and yes, you need to also put part, so you can raise money to purchase that property, okay. So for to run a company, you can issue shares and get the capital. To buy a property, you can apply for a loan, mortgage loan, and raise capital to purchase that property. Uh, so similarly, this financial investment kind of give you some information with regard to how you are going to make that decision, right? So when you make financial investment, so share market, you are going to get a X amount of return, but you take Y amount of risk. Okay, so then again, if you invest in and put money in a fixed deposit, you don't get take any risk, but you get a return. Okay, smaller return. So then that kind of a information is given. So according to your risk appetite, you can take that decision. Okay. So likewise, the financial investment give you kind of a guide to guide for investment decisions, right? Uh, so let's now discuss about some of the investments that we talked about, the markets. So it's a kind of a market, financial market. So there are buyers and sellers. There are people who want to buy shares. Also, there are people who want to sell. So buy and sell, person who buy at a lower price and sell at a higher price, then he gets a capital gain, right? That's in the stock market. That is applicable for properties as well. So then again, securities. So here, securities actually refer to kind of treasury bills and treasury bonds. And also there is a process that you need to follow making an investment. So that's also part of that. And also theories, there are so many theories that we are planning to learn in this lesson today in the later half. Okay, so those are some of the things. And then two major markets. One is organized markets, and there are uh, there are markets which are in the physical location. Like for an example, for a classic example is you go to a supermarket. Okay, and there you not supermarket like Polar. Okay, in so many towns there are Polar, Sunday Polar fair, you say fair, Sunday fair. So you go, there are so many buyers and sellers. They have price tags also. Maybe it's potato 100 rupees for 500 onions, fish. So there are markets which are physically exist. One example is physically exist market is Polar and other supermarkets. Then Colombo Stock Exchange, some of the markets, for example. But there are again markets which are not physically available. We call over-the-counter markets. Okay, we talk about those things very in detail, and I promise that yes, I tried to explain this in my mental model. So I promise you to promise you that I will show you some videos so that you all learn these things. So what exactly happening inside the treasury or in the market. So I'm trying to give one of those videos right now. Play one of those videos.
Well, what would you want to do? Looking to buy or sell?
Yeah, but 43 sounds really tight. So why would you want to reduce your position at such a low level? The thing is, if they're changing the dollars into Saudi, that means they're buying and selling Saudi with the central bank.
My name's Philip Beckle. I'm co-head of the EMEA FX and interest rate trading group at BNP Paribas, and we're a group of about 25 traders spread across the Europe, Middle East and African time zones. We also have trading hubs in Moscow, Bahrain, Budapest, Warsaw, Sofia, but London is our main centre where we have the highest headcount. Bleeping sound that we keep hearing on our desk is the voice of stealing machine, and they're actually incoming calls. And those calls can come from anywhere, from another bank to a counterparty, or even an internal call from another BNP Paribas entity, for example, New York, Montreal, Milan, everyone has this system, and that's one of the principal methods we.
I think these are the dealers that I've talked about. Front office. These are the dealers that actively involved in negotiating with different parties internally and outside, locally and overseas in foreign countries. They have their departments or units in outside as well. So it's kind of inside story what is exactly happening. Okay.
Use for trading. BNP Paribas. Yeah. There's a bond auction in Tel Aviv for government bonds denominated in Israeli shekel, and we're bidding a total of 700 million shekels. And the order's just going in through now. $100 million is 375 million shekels, so it's just about $200 million that we're doing. We like these bonds because there's a positive, what's called a positive asset swap, whereby the yield on the bond is higher than an equivalent yield in the money market. There was an auction in Hungary today for Hungarian government debt. A news report came out from Bloomberg, which is a news service, and our trader in Budapest was quoted on the report that Bloomberg would have telephoned him up and asked his view on the market goings on, and it's just been quoted in that report here.
The situation in Israel is a bit escalating a bit.
Yeah, there's an exchange of fire between Israel and news report came out 15 minutes ago, and that's typical of the sort of global events that affect our markets, particularly since we're sort of hands-on trading. Conflict in Israel is a fact of life. What we will be watching is if it escalates and gets worse. If it does escalate, then we have a problem. It's not absolutely every day that we have to meet on the desk. It's only on an ad hoc basis, depending on how much work we have.
Yeah. What's that?
$30 million across currency. ING Turkey wants to pay.
As a cross currency?
Yeah, that's correct.
We just got a request for a price in a Turkish lira cross currency swap. It came through our Turkish sales desk through the swap box here. It was an 18-month cross-currency swap in $30 million. And we just priced that up, talking to our voice brokers, and then using our pricing system here. If Turkish yields move by 1 basis point, our profit and loss can either go up or down by, say, 10,000 euros. So we just got the auction results from Israel. Put in competitive bids for up to 600 million shekel, and the result was we only got 400 out of that 600 million. It's a relatively small trade for us because that amounts to just over $100 million. Because the duration is so short, the actual economic significance of it is quite muted.
I mean, the inversion of the curve still doesn't make any sense to me. But it just is wrong. Thanks a lot.
If we were trading any other currency like euros or dollars, it's a 24-hour market. But because our currencies are less liquid, more exotic, it really ends with London. And tomorrow's another day.
On the trading floor of Vanguard's fixed income desk, can you describe the process of what our traders go on the trading floor of Vanguard's fixed income?
Sure. So traders are going to be given orders from portfolio managers. They're going to take those orders, and the first thing they're going to do. Sure. So traders are going to be given orders from portfolio managers. They're going to take those orders, and the first thing they're going to do is look at the liquidity in those markets to see how they should go about implementing the strategy.
Yes, I wanted to stop that and I really couldn't. So sorry about it. Anyway, did you learn anything about anything from that? This is very much similar to what we tried to learn, last 1 hour or so. So one thing, can you remember they were talking about the cross-currency swap? So that is, swap is something that they deal with. Swap is a example for what? Example for, I think, financial product that Treasury Department is dealing with, very much similar to forward contracts and all. So I said Sri Lanka is not very much into that market, but these foreign markets are dealing with those areas. So let's now try to having watch that video. So I think if we can go through the slides little faster, I think we should be able to learn some of the things that highlighted in the video. So then I can relate to the real life scenario as well. Okay. So let's start from here. So they were talking about bids buying at a lower rate and selling at a higher rate. So they really they make profits, right? Then again, the person who talked, so he's a dealer. So there are so many other people assisting him. Can you remember a person who had a kind of a Chinese look? He said there is a kind of a terrorist attack in Israel. Okay, so some other country, I can't exactly remember. So the moment those political, geographical risks come into play, market drops. So then if you buy at maybe something at certain price, maybe so 10%. So if the situation start worsening, that can come down. So you buy at 10% thinking that you would be able to sell it at a higher rate, like 12%, but things don't go well, that 10% can come down. So then you are at a risk. That's what he said. So if things go wrong, so they are in trouble, right? So I think this is the market risk that we talked about. Then when the prices are highly volatile, so then they are in trouble. So there is nothing much here. Again, they talk about basically bonds, and so this is again. So the person who was a dealer, so they also talk about some other foreign currencies, right? They if they want to deal with foreign currency, they need to be all around the world, right? They need to have offices all around the world, from Japan to USA. So because they deal with that much of volumes of business, right? So there are two types of markets, like one is organized markets and the other one is over the counter markets. Just before stop the presentation, I just mentioned these two types of markets, but what you need to know here is the main differences between these two markets, right? And examples for each one. Right. I said the examples of organized markets are stock exchange, and also our weekly polar affair is also a example for organized markets, because Now let's see some of the features of organized markets. So they say they have a physical location where all traders trading take place. Yes, polar or stock markets, both sides, both places you have buyers and sellers. And also it says they have transparent mechanism. Everybody knows what others are doing because they are a price, buying price and selling price is given, right? If you go to a stock market, if you have not gone to a stock market, you would have seen in the television, their buying prices and selling prices are given. So that is the information is given. So it is transparent. So example, stock exchange. So the opposite of that is over-the-counter market is it's not physically available. It is connected, like that dealers, they are connected with so much of high-tech equipments. Can you remember that they were talking about Bloomberg? Bloomberg is a system where this securities details, prices, and so many other information even given in these sites or systems. So they give who is bidding for certain auctions, who is going to buy this, who is going to buy and sell certain products and things like that. So everything is even given in the information system, but there is no physically available location. So that's the one feature, but in organized market that is there. And then again the next is network of dealers. You don't know which price at which price they buy and sell, and so that is not available. It's very much connected. So buyer and seller is not meeting, so it is not transparent. So organized market is transparent, the other one is not transparent. And examples of organized market, we told the stock market, and over-the-counter market example is foreign currency market and Nasdaq. Okay, Nasdaq is a kind of a foreign currency market in USA. So those are some of the classic examples for markets in financial sector. Okay. Then again, these markets, we can classify these markets into two basic categories. One is primary markets and the other one is secondary markets. The primary markets where you issue securities and traded, but once it is issued, then that securities are buy and sell in the secondary market. Okay, London Stock Exchange, Colombo Stock Exchange, or any stock exchange is example for a secondary market. But this primary market example is I think primary market, you probably know this. We had in Sri Lanka we had an issue with bond market in central bank. This bond scandal. So there is so many primary dealers like this. We know this story about former central bank governor involved in this scandal, and and his son-in-law. So they had this primary dealer company, right? So it's a kind of a different, it's a very limited number with primary dealers and the corporate or governments, right? So where this primary dealers comes into place now, for an example, if you have studied the budget proposals for this year, there is a huge budget deficit, right? So it says government income is rupees about 2,200 trillion. Cost expenses are 2,200 trillion Sri Lankan rupees, whereas our income is 1,400 trillion. So what is the gap? About 800 million gap, right? So, but you know, our construction work is happening, government is moving, right? They find money. So how do they find money for their investment projects and budget to implement budget proposals? So they don't have income. What do they do? They have you know, have these primary dealers who are dealing with the government treasury. They tell these primary dealers that we need this much of money. Okay, let's say we need 500 billion rupees. So you all go and find money. So then these are primary dealers. They are very much similar to brokers. They try to find money in Sri Lanka and outside Sri Lanka. So this is what that those people did in that video. They government or corporate, they give them a target to find X amount of money. So these people go and find those money. So like so when there is a property to be sell property to sell, there are brokers, right? So they try to find a buyer and seller, they meet and they get a commission, right? This is very much similar to that, though they get a cut. So when government needs money, when they don't generate enough income, they get these primary dealers to get money. Okay, so let's assume that they need money and they issue bonds, right? But there is no bids. They actually don't get any people asking. Nobody wanted to invest. Recent past also this happened. The government to get money, they issue bonds, but nobody was interested in buying bonds. So what happened? Then they can't. They anyway need money. But then what central bank does is, central bank themselves buy those bonds. Okay, to that amount they print money. This is the I think the allegations that put forward by so many opposition politicians. So printing money, right? That leads to inflation anyway. So for you to understand that, let me explain that process so that it is clear to you. First thing, when there is a government to run, government need money. Okay, so they are, as of as per the budget proposal, they don't have enough income to spend for their projects and to run the government or country. So in that case, they ask their primary dealers to find that extra money. Okay, so extra money, what they do is they to raise that fund, so they issue bonds at primary market. Okay, primary market. So if there is any investors, they can invest. They invest, this money come to the Sri Lankan government. If there is no one to invest, what happens? Sri Lankan government, they won't get money to do their projects or run the country. What happens? So then on behalf of Sri Lankan government, central banks, independent unit, no, there is no investors. So central bank buy those, invest in those bonds. So then we have a government as an investor, although it is a Sri Lankan independent party, they have an investor. So to that similar amount proportion, they print money. So Sri Lanka print money and circulate. Then so that similar amount, they print money and so they have money. Then they circulate and they do their projects. That's how it happens, right? So then primary market raise capital. Like I said, they issue bonds and raise capital. If now central bank has purchased invested in these bonds. So at a later date, the central bank can in the secondary market, maybe in the stock market or through their dealer network, they can sell these bonds to the general public or different companies, right? This is happen in the secondary market. So secondary market still important because if there is no secondary market, there can't be primary market also, because then the secondary market is the one that gives the liquidity. Okay, if there is no secondary market, it is very difficult to for primary market to exist. So for a classic example would be vehicle market, right? So there are few vehicles imported brand new. There are certain type a category called reconditioned vehicle, which uh, actually used in foreign countries like Japan. So then after a while, after using it, they export it to Sri Lanka. Then we register here as new vehicles. Then after about 2-3 years, some people they change that, they sell that vehicle and buy another new vehicle. So for them to those who want to buy, you know, brand new or new vehicles, they should be able to sell their old vehicles. For that to happen, there should be a secondary market, right? So since government has imposed some restrictions on imports, uh, particularly vehicle imports, I think there was kind of a demand for Sri Lankan second-hand market vehicles. So Alto, which is about 1.67 million, suddenly jumped to about 2 million, 2.2 million. Okay, about the significant increase because there was no vehicles coming into Sri Lanka now because of import restrictions. That helped those who really wanted to sell the vehicle, they could sell that vehicle at a very attractive rates, and then they could go for the next vehicle. But only thing when there is no import, that also come to an end at a very early stage, right? Do you have any questions? How primary market functions, secondary market functions, and things like that? No, no question. Then let me ask a question. So can you give me two main differences between organized market and over-the-counter market? Can one of you tell me? Two differences? What do you know about over-the-counter market and organized market? How about the location? What did I tell you about the location? What has a physical location?
Organized market.
Organized market, there is a physical location, and the other one does not. Then next one, another feature, another aspect of organized market, which can be differentiated from OTC.
Organized market is transparent.
Transparent, where buyers and sellers are, they meet each other and take decisions based on the available price and prices, buying and selling prices, whereas the other one does not have transparent mechanism. Very good. I hope it is clear to you the differences between primary market, how it operates, and the value of secondary markets. So how the value that it creates to have this to gives liquidity to the primary market. So money printing and what is the relationship between money printing and primary market and things like that. I think it is clear to you all. Right. Do you need a break, or can we go as it is? Two of you, do you need a break? Let me know. Tell me, do you need a break, or can we go ahead? Hello?
Need a break, sir.
Need a break. Then we'll meet another 10 minutes time. Okay? We'll meet 3:25. Okay, exactly. Thank you. Right. Seven, you are there, right? Right. We'll start. Hope the other one also join the course. Shall we wait 1 minute? Right. Anyway, now we are moving to learn about portfolio management. For that, we need to know what is a portfolio in the first place, right? So portfolio is a kind of a combination of many things, right? So portfolio, if it is a bank portfolio, so bank portfolio can have a product portfolio, right? So then you have in a product portfolio of bank lending side, you have housing loans, then personal loans, business loans, credit cards, so many other aspects, right? So likewise, when it comes to investment portfolio, there are so many things that a person can invest, or organization or company can invest. It could be maybe treasury bills, bonds, shares, mutual funds, or you can have your cash with you for urgent requirements, so for you to spend for your day-to-day expenses. So you can have it right now. You don't have to have money in your wallet, right? So maybe you can have have money in your bank, and you can have the ATM card. That's similar liquidity uh, you know level you can get by having a ATM card. But it, and on top of that, you have additional benefit of protection, right? But in terms of portfolio meaning is so many assets in the or investment in one on the one go. So for example, if you're 100 million 100 million rupees, they can invest in stocks, they can buy a proper apartment, they can buy another kind of they can invest in shares, they can invest in bonds, or else you can keep some money for yourself. Okay, so that's the portfolio is combination of many investment tools. So then what is portfolio management is now, like in earlier video we saw they are managing, they in fact they have they are the people who you know got money, got funds for various businesses, right? The portfolio manager is a person. Now if you have 100 million rupees, maybe you have an ancestral property somewhere in Colombo. If you happen to sell it, you have 100 million, you don't know what to do. So then you can have a meeting with portfolio manager. Then he will tell you, so what exactly you have to do with the 100 million rupees for you to get the best return. Okay, he might tell, he or she might tell you to invest maybe a certain percentage in stocks, a certain percentage in bonds and treasury bills, and to purchase high rise building apartment. Okay, so maybe or to invest in shares, or to keep certain amount of money with you. So he invest and pension funds. So then he will calculate and show you your return. If you do this, your return would be this much. So but if you simply put it in a fixed deposit, your rate these days about 6-7%. If you really want a higher return, you need to get some expert advice. Otherwise, what will happen is if you happen to invest in very high risky assets, there can be downfall also. You can lose the entire thing. Then you don't have money also. Okay, so you need to have some expertise for that. So the investment and returns, I said there is always a positive relationship. Higher the risk, higher the return. So if you really want to get the best return, you must take a risk also, right? So that's something that you need to remember. There are so many other aspects that when you managing a portfolio manager that need to look at. Okay, so like I quote an example of having you 100 million and going to a portfolio manager. So then portfolio manager, there are so many people come to him, so he should be able to figure out when a client comes to him what exactly their budget is, in the sense how much of money these clients have, and what is their expected return. So maybe they need a return of maybe 15%. They know, these people know, they, if they deposit in a bank, they get about 6 to 7%. So because they come to you, come in search of an expert to get that return to higher level, to make that return to higher level. So you should know what his expectation, how much of money they have, and how much of, and the risk that the person willing to take. Okay, so with that risk appetite, kind of boundary, only that this person has to give his solution. Then so in line with his requirement, the portfolio manager can kind of customize a solution and say, yes, you have this much of money, you invest in you can give different investment tools, shares, and this much, and property this much, and also expected return of each investment, and the overall weighted average return of the entire investment. So if he's happy, he will take a decision to hand it that over to you. So then from that, you probably, the portfolio manager's income is a fee income, right? That's how it works. So this portfolio managing business is in a bank is done by the treasury department. Let's say now in certain times treasury department bank could have excess money, right? So there can be so much of deposits coming into the bank and repayments, but lending is not happening the way it should happen. But you can't keep money idling. So if you do that, your bank level profits will get hurt. So treasury should know how much of money you have. You can put in the repos. If you don't have any investment plan for some long period of time, 3 to 6 months, you can invest in treasury bills, bonds. So if you have in excess of certain percentage, you can invest in share market and so many things, right? So that in fact decision is taken by the treasury department, but they need to in fact give a kind of a proposal to the senior management, and through senior management, the board of directors, and get their approval to do that. But end of the day, treasury department has a kind of in profit target. So if they don't take proactive action, they might lose money. So if they lose money, they don't achieve their target. So anyway, you need to use their expertise and take correct decisions, right? So now we are moving on to learn about the bonds, to particularly fixed income tools. We call we gave a couple of examples for fixed income tools. One is treasury bonds, and the other one treasury bills, right? Here, so before going into detail about bonds is something that, again, that you basically in day-to-day life, you don't know what the bond or treasury bill is. So to address that issue, let me give you an example from the day-to-day life, right? So like a customer comes to walking into a branch and he asks for a 1 million personal loan. Okay, then who gets the money? Who gets the money? So who gets the money? Customer gets the money, no? So we call customer as a whom? Customer is a borrower, right? Then the bank, what does bank do? Bank is investing, right? So his bank is, by giving this loan, his bank is investing in an asset. That is asset meaning in a loan. So for that asset, they are making a interest income. So that is the return. So bank is giving the loan. We can call it bank is granting the loan. Okay. So by granting, what they are doing is bank is investing the money in a maybe a customer or borrower's project, or maybe borrower, right? So similar thing happens in the bond market also. So bonds also, there are two parties. Party who is giving out money, we call uh, uh, investor, and whoever takes money we call issuer. So there are two parties. Okay, one is issuer and the other party is investor. Then the issuer is the borrower, right? The issuer is the borrower. They take money, like the bonds that issued by the government. So government, when they do not have money, enough money, they issue bonds. By issuing bonds, they take money. So I explained just before the interval about the government raising money for their projects by issuing bonds. So what they do is they borrow money. So outsiders, they invest in these borrowers, in these bonds. So the similar thing here, the basically corporates and government are the borrowers. There are outside, maybe foreign investors, there are local investors who can give that money or invest in those money, in those bonds, right? The first thing that you need to understand, two parties, like in a loan, there is a issuer and the investor. Issuer is very much similar to borrower. So examples for issuer is government, maybe big corporates. There are so many outsiders, maybe companies or individuals can invest in foreign currency or local currency, right? So then another aspects in loan, I said so bank earn an interest, right? The customer pays interest. That part is an income for the bank, right? So bonds, this interest component, we give a different terminology. Okay, so we call it a coupon. We don't call in bonds interest rate. We call it coupon. So bonds, what they earn is coupon, not interest. So it's a kind of a difference in terminology, but its meaning is almost the same, right? But and also there is a loans can be given 3 or 5 years, right? So similarly, bonds also can be given, maybe bonds, in fact, long term, for government's long-term money requirements, they issue bonds. For short-term money requirements, they issue treasury bills. For up to 1 year, it's treasury bills. More than 1 year, it's bond, right? So for treasury bills, for short-term money requirements. Right. Here, similarly, bonds, like loans having a tenor like 3 to 5 years, bonds also have a maturity period, like maybe could be from 2 years to 30 years, right? bonds to period could be ranging from 2 to 30 years. That's the maturity period. The amount granted, maybe let's say in a loan we say amount granted is capital amount granted 1 million. So in bonds we don't call it amount granted, we call it face value. So there are few things. It's very much similar to loan granted by a bank to a customer, which is very much similar to bond. But in bonds, in fact, the borrower is a government or a corporate. Then the investor is an individual or company. Okay. Like in loans have a maturity period 2 to 3 years. Similarly, there is a tenor for bonds. Loans, we say we earn interest income. Bonds, we say we earn coupon. And then there is a loan in the original amount granted, but maybe 1 million. So bonds, we call it, it's a face value, right? Those are the subtle differences between bonds. Just to give you take a local example and try to explain what does mean to a bond, but it is very much what is within us, but it's a different way that we explain it. That's how big things explain. Normal things we give different names and tell it differently, so then it looks complicated, but it is something that we know already, but we use different terminology. Right. I think both Vinuri and Sewandi are there. So can we just have a small discussion? So can I have the corresponding terms of loan to bond? I'll tell the loans terminology. You tell me the corresponding term which is used in bonds. Okay. Loan interest. What is the corresponding term in bonds? Tell me. What's it? What it is? Sewandi? What we call interest for loans. When it comes to bond, what do you call it? You can make mistakes, but you can tell. We call it what? Coupon. Right, coupon. Then customer takes money, we call borrower. But again, in bonds we call them what? Borrower, or another term we use to borrow, issuer. Right, issuer. Then the other party, the opposite of borrower or issuer?
Investor.
Investor. That you got it right. Then so I told we say loan amount, granted loan amount. What is the corresponding term in bonds? That is face value, right? Face value. You need to remember that these things, because we are going to do some sums next week, how to determine the price of a bond and a treasury bill. So you need to know these differences and terminology. So like in bonds, you have terminology tenor, both from bonds from 2 to 30 years, but in loans it could be 3, 4, 5 years, right? So that those are the basic differences between bonds and tenor and loans, right? This is an example, right? Can you just read this example so that we can move on to the next? So whatever we learned in the previous slide, we try to apply them. The annual interest amount is found to be multiplying the coupon rate by security face value. Usually 1000. For example, bond with 5% coupon and 10 years to maturity will pay 50% of interest each year for 10 years. Payments are usually made semi-annually, but may occur at other intervals, right? So now, what is the face value of this bond? What is the face value of this bond? 1000, right? He said the original granted amount is the face value, 1000. So we don't call it interest. No longer we call in bonds interest, we call it coupon. It's the same, 5% coupon. Okay, so 1000 into 5%, how much? 1000 into 5%, how much? 1000 into 5%, how much? That is 50, no? So annually 50 to be paid. That's very much similar to the interest, right? That can be the 50 per annum, so can be paid in semi-annually. If it is semi-annually, how much for each 6 months? How much for each 6 months? There are, say, 6 months, no? 2 into 6, 12. 50 for 12 months. For 6 months, how much you are going to pay?
25.
That's right. So those are the things that you need to know when we start doing the calculations. But basically today what we are trying to do is as much as possible try to cover theoretical aspects, right? So what are the factors determine the coupon? What exactly the coupon depends on few things. One is the prevailing interest rate in the market, right? Depending on the interest rate, your coupon amount will vary. Now, again, we can relate that to the normal banking context, like so. Now AWPLR, otherwise the central bank average weighted prime lending rate is about 7%. Okay, so different products like housing loans given at 8% and maybe again personal loans and 10-12% and business loan again 10%. So depending on, so when it was before COVID, it was the price rates were about 13 to 14%. AWPLR was about 9%. So now interest rate came down. So accordingly, bank loan products interest rates also differ. Likewise, when the market interest rate changes, the coupon rates of bonds also changes, right? So when the maturity period, when it is 2-year bonds, interest rate is relatively low. But if it is a high longer tenor bonds, you get a relatively higher coupon, right? Similar to loan customers, so depending on the rating, okay, so there are A rating customers, AAA rating customers, BBB rating customers. When you have a very good customer against the customer, average kind of a customer, who gets the best rate when lending? Best customer or average customer? Best customers get the best rate, right? So because their repayment behavior is very much favorable. Similarly, when the issuer or the company with higher rating will get a relatively lower coupon. So let's say now in the Sri Lankan context, so now our country has been downgraded, right? So Fitch and Moody has downgraded to triple C minus or something like that from B. So when we go and borrow from outside world, so we have to pay a higher interest than before, because our credit, we are known to be like a notorious person in the world market, right? So they feel that if they give money, invest in Sri Lanka, we are may or may not pay. So we are our character is not good in Sri Lankan market. So when decide the coupons, you need to remember there are three major aspects. One is interest rate, the other one is credit quality, other one is maturity period. Depending on that, your coupon rates also differ. So again, bonds maturity, coupon yield and total renewal. So the coupon bonds, depending on the interest rate, there can be this coupon is very much sensitive to coupon yield and overall return. If you invest in a bond, what you get total return depends on three factors. One is interest rate. Then again, like I said earlier, whether it is a short-term tenor or long-term tenor, then the higher quality or risk rating of the company, and the exchange rate. Okay, so if investor invest in a bond which is denominated in a foreign currency, let's say for an example, US investor investing in European country where their currency is euro. Okay, if that euro currency depreciate against US dollar, what happens is return, what is expected to get, this investor get expected to get some return. So we will get that in euros. If that currency depreciates, so this US investor also, his net income also get affected. So that is something to that look into when they invest in bonds. So there are three factors when you invest in bonds that you need to look at. Again, the three risk factors, right? One is interest rate. When the interest rates are going up, you are at a risk when you, in terms of your total return. Again, if your risk rating, you are investing in a bond which has a lower quality, you are running into risk. Okay, as against AAA rating company. Then again, if you are also investing in a country where the foreign currency is going to depreciate against your own country, then also you are going to lose your total returns. Okay, that is in terms of by investing in bonds, your total returns can be affected by three factors I have mentioned. Right. So, Vinuri, Sevandi, what are the three risk factors the bonds are exposed to when it comes to their total returns? What are the three risk factors we talked about? One is interest rate, then
Risk rate,
risk rating, then
exchange rate.
exchange rate. Great, excellent. So that's basically it is. Now, so I promise another. Going to run another video. Let's watch that video.
On the trading floor, I think it's fixed income debt.
Now, fixed income is bonds and treasury bills. Okay, this video is all about fixed income tools, right?
Can you describe process of what our traders go through in making these for our clients?
Sure. So traders are going to be given orders from portfolio managers. They're going to take those orders, and the first thing they're going to do is look at liquidity in those markets to see how they should go about implementing the strategies. They have many different tools at their exposure that they can use to execute, and they need to go about it and find the most appropriate and best way to implement those strategies without having a tremendous amount of impact or having a ton of cost to our shareholders.
So is there a lot of movement? Are they monitoring different funds, and what does that look like?
There's a tremendous amount of movement throughout the day in all of the different markets. Typically, we're segregated in different areas of expertise. So you're going to have an FX trading desk handling all the FX orders. You'll have a fixed income desk handling the bond executions. And then you'll have another desk handling all the derivatives executions. And that way, those traders can specialize in the different asset classes, because ultimately they want to be able to execute in a way that limits the amount of impact and limits the amount of cost that it takes to trade.
So how many funds might one trader be monitoring throughout the day?
It depends, and it's different by desk. We like to set up our traders with the portfolio manager. So in that situation, it might be a very custom desk where it's just emerging market bonds. In other functions like FX, those currency traders are handling all of the currency needs for the entire organization. So coming from equities, fixed income, even from our international sites. And that way those traders are just specializing on that specific asset class.
When many people think about Vanguard, they think about indexing. So can you talk a little bit about our active trading strategy?
Sure. As one of the largest active portfolio managers in the world, a tremendous amount of the trading that is done here is for the active portfolios. Very similar to trading for index portfolios, the main difference is portfolio managers are trying to outperform the benchmarks. Therefore, traders tend to be more aggressive, and the urgency is much higher for trying to get active orders done. Ultimately, costs still matter, and the lower amount of cost that we can have when trading, the better it is for our shareholders at the end of the day. There's a tremendous amount of collaboration throughout the different desks. A lot of what happens in the fixed income market affects the currency market, affects the equity market. So there has to be a lot of interactions between the traders. And also with our screens, we get a tremendous amount of information delivered to us daily, and we got to decipher what that information means and how it's going to impact the securities that we're trading.
So how does the work that our traders are doing throughout the day impact our investors' goals?
So ultimately, costs matter in returns of portfolios. All the traders here, including the traders around the globe, have our shareholders' best interest at heart. We want to keep the trading costs at a minimum to give our investors the best chance of success.
So clear, right? So let's go back and see how we're going to relate this. Okay, I think there is not much difference. So where we have stopped here. So this is portfolio manager. He talked about different asset categories: fixed income, treasury bonds, bills, equities, foreign exchange, and things like that. I think gentleman spoke about a portfolio, complete portfolio, and also he also talked about risk aspects, and they wanted to minimize the costs to give the best return for their shareholders. So he talked about maximizing the shareholder returns. So they talked about shareholder expectations, and according to this appetite of shareholders, they need to customize their products, right? So these are technical aspects. So we have discussed that. I think interest rates, credit quality, maturity, which is driving factors of coupons, and then total returns are actually there are three risks for total returns. One is interest rate, and then the quality of the rating, and then finally the exchange rate. So I think just to, next week we are planning to, I think, like I said, determine prices of bonds. For that, this present value calculations you need to know. So I just in case you have not covered this, I have put this. So if you say that you have covered in another course, project management or something, you learn this. So Sevandi Benuri, have you all learned this somewhere else? Present value calculations? Can you remember, or you have attended that class? Okay. So let me not very basic details, but try to present how to do a present value calculations. We do couple of examples also, then you should be able to understand. Okay. So this is not a part of this course, but this you should know how to do this calculation for you to understand how to do a bond price calculation. So that's what I wanted to keep this here, right? So for any cash flow, you need to know the discounting factor. You can have the discounting factor. So we'll give the discounting factor tables next week. That's the table. So you get the discounting factor, and according to the number of years and the interest rate, you can get the discounting factor. You just multiply the cash flow, you get the present value of cash flow. So present value in the sense, let's say now today we call it, today is the year 0, right? But if you get maybe 100,000 another 2 years time, does that value value of the 200,000 another 2 years time is equal to today's 200,000? No, it differs. What do you think?
Not equal.
Not equal. Today 2 years time, 200,000 in 2 years time is less than 200,000 today, because it is multiplied by this particular discounting factor. Then we can get at the exact amount how much it value today. Okay, number of second year. So depending on the interest rate, we get the discounting factor. So by multiplying the expected cash flow in next 2 years, second year, we get the present value. So let's do it in an example. It's not rocket science. You should be able to understand. Okay, same thing. You can get that value from this. Okay. Now this example says you just bought a new computer for rupees 3,000. The payment terms are 2 years. Okay, in 2 years time you have to make the payments. If you can earn 8% on your money, that's the interest rate, how much money should you set aside today in order to make the payment, right? So 3,000 is divided by 1 plus R. R is 8%. R is 8%. It 1 plus 0.08. 1.08 into the power 2, right? So that's how we calculate. Then the value of today's value of 3,000 in 2 years, it is equal to 2,572, right? So meaning you need to keep 2,572 today for you to have 3,000 rupees in another 2 years, because interest will be added on. So you will, by end of 2 years, you will get 3,000 for you to make that payment. Clear? So similarly, you can have not only one cash flow. Maybe second year you get a certain amount, third year you will get another amount, fourth year you get another amount. Then you make things complicated. So then how are you going to get the cash flow? Similarly, the first year 1 plus R into the power n. N is number of years. First year n is equal to 1. So the second year cash flow is, we can denote C2. So second year 1 plus R. R is the same to the power n. N is again 2. N is second year, no? N is equal to 2. Likewise, you can have a sequence of cash flows and calculate each cash flow separately, and if you add it on, so then you get the present value of these cash flows. So let's do it in a simple example. So 100 rupees, if the interest rate is 7, so you can have there are two cash flows, 100 divided by 1 plus 0.07 to the power 1. So then 200 divided by 1 plus point should be mark should be there. And if you calculate this, the 200, then you should have 265.88 today, right? That's how you calculate multiple cash flow. So this is kind of a graphical illustration. I think you should be able to read and understand this, right? So 100, 93, 200, then again 172.42, right? Total. So this is again another example. Given $2, one received a year from now and the other one 2 years from now. Okay, so $2 interest rate 20% and the second year interest rate 7%. Two different interest rate. Then how much is the value? So this is something that you can try. Okay, then today's your spending. If there is a project, you have to spend. When you spend, we cash going out of the system. We call minus, right? 170. Second year also you need to do some maybe building factory. Year 0 you do the construction. Year 1 also you do some construction to build a factory. So you first year you spend 170,000. Second year you spend 100,000. But after completing the projects, second year you earn a net revenue of 320,000. So if the project to be viable, the net present value of this cash flow should be positive. If now 170,000 you spend now year 100,000, you get an income 320,000. Now you need to think of this income in today's terms. So whether for you to go for this project or not. If it is today's term, it is positive, then you can go for it. Today's term, it is negative. Are you going for that project, or you are going to abandon that? If the today's terms value is negative, are you going for that project or not?
No.
No, right. So so let's see what is the net present value here. So discounting factor, I told we'll give you in the table. So either you can discounting factor can have by 1 divided by first year interest rate 1.05, or you can get it from the table. So we will show you the tables next week. So then you should be able to understand. I think if you have done the project appraisals, you already done it. You have already got it. So the second year discounting factor. So if in the table second year column with the interest rate of 5%, you get the 0.907 without any calculation. So when you apply this to the cash flows, first one 0, year 0 discounting factor is 1, right? Today, if you spend 170,000, value is 170,000, right? So you are multiplied by that 1. So that's why it's equal to 170,000. So likewise, then you second one, your net present value is 95,000 negative. First one 170,000, 320,000 to second year equal to 290,000. So when you add up, you get a net present value of 25,000. So then this is going to be adding value or beneficial to the organization. Then you probably will go for a project like this. So discounting factor is a present value of, you can say, 1 rupee. So that's the concept, right? So now we know what is about all about fixed income, treasury bonds, bills, basic understanding, some concept, portfolio management. Now we are moving into equity management, right? Equity management, we try to learn the trends in equity market, both USA and India, some of the concepts of portfolio risk and calculating the portfolio risk, beta and unique risk factors, diversification of risks, and these are some of the concept like bonds. We learn certain concept like coupon, tenor, interest rate, yield, certain small concept, face value. Similar to that, we also in equity market also will try to learn some other basic concept that you need to know at this level, right? So let's say now how the performance of a stock, right? This is with regard to US market, like 1900, right? 1900 today 2020, but we have data till 2004. Let's say how we can what we can learn from that. So now let's say $1 in 1900. So green is treasury bills, bonds in blue color, then red color stocks, right? So now see the value in 2004. Its market price $1 has increased to 61 treasury bills, bonds 147. If you someone invested in 1900, it had multiply that investment by 15,000 odd number. So it's huge amount, right? So this is what we call higher the risk, higher the return, but it does not happen this way alone. So let's move on and we'll know there's a risk element also, right? So this is US market. Let's see how this happen in Indian market. So 1900 Indian capital markets, open economy is not there. It's very close economy. 1900 under British colony up to 1947, so you don't have stock markets and this liberal capital markets. So we have data from 1978. So 1 rupee in 1978, it had increased to 12,696 in 2004-5. So similarly, bonds increased to 2,727, and stock treasury bills increased to 1,105. You probably now understand what we are trying to say. If you invested in stock market, your value of investment is significantly high. Okay, but you get some of the risks also. So if you the same thing you can one stock we have got some data about one stock, that is Demo. Is a company that basically involved in vehicle industry, Benz to Tata vehicles. So they are how their share price stock moved from August 2009 to August 2011 is given here. So August 2009 to about 2000, maybe 2000, early 2010. So it's almost static. There is no change. So from 2010 onwards, it started increasing very significant way. Its share price hovering about 100 rupees. It had gone up to about 1,800 in January 2011 within 1 year. So this is a significant thing that happened in Sri Lankan stock market industry history, because this reason this happened, like similar to period that we are going through right now. There is an import restriction in up to 2009, late 2009. There's import restriction was in place. Suddenly, that import restriction was lifted in 2010. Then again, so there the vehicle sales started to boost, and also not import not import restriction. There was a heavy duty tax on the vehicles, which was very high during up till 2009, late 2009. Suddenly, duty component has reduced, then made the value of the vehicle cheaper. So then, when the prices are cheaper, definitely the economic theory, sales go up. Okay, when the prices are low, demand goes up, your sales are going up. So as a result, demo company financial performance has increased. People saw that trend and they started investing. There was high demand for demo share, and then there was a tendency of picking up the share price of demo. So that's what happened. So that's what in linear terms you see that you get higher value for your share. But this is now see in from 1900 to US market, there are certain years there is a negative return. Okay, you x-axis down 20, -20, -40. There are few years, number of years the stock market has not done. If you have invested during that period, your stock is not going to earn that big amount. You are going to lose money, right? So that happened in US history so many times. Okay, so if your investment was there and you wanted to realize the investment, you are losing. So similar thing happened in India also. Okay, in certain years the share market are not done well. So you really similarly, if you wanted to realize their investment, you are going to lose money. So so you put it in a histogram. In you see this return, and if you put it in a graph, the return against number of years, this shows that it actually goes in a bell shape curve. Okay, this is a concept that developed by a person called Markowitz. So he said expected return of the company over a period of time, so it moves in a bell-shaped curve. Okay, but this is a typical bell-shaped curve. There can be some bell-shaped curves moving towards right hand side, then your return is relatively high. So similarly, this kind of a bell-shaped curve, your average return is about 10%, right? You go to this one, your average return is about 30%, right? So it's medium return, right? The middle one. So this one about 10%, right? So that average return can go vary from stock market to market. So these are some another few things that I wanted to highlight here. So now let's say now our country, we have this COVID, no lower COVID, right? So we have in the share markets some of the hotels. Four group companies own hotels, like John Keel's, they own Cinnamon Hotels, and there are Jetwings. There are I think Aitken-Pence. There are a group of hotels that owned by Aitken-Pence. The Cinnamon group is owned by the John Keel's. So if you invested in these companies, so tourism is not doing well at the moment, then the company is not doing well, your financial performance coming down, your share market price will come down. Okay. Similarly, if you have invested in let's say hospitals like Durden's, Navaloka, right, Apollo, right, Hemas, so you invested in a hospital like that. So there are good business for hospitals, right? You private, you get treatments, you go for tests, and so many other. Anyway, there is business for The hospital, their shares are doing well. So their financial performance are good, and their demand, there is a demand for the share. So the performance of these shares are doing well. If you invested only in tourism, you are going to lose. But if you invested in only in hospital, you are going to gain. But if you invested in equally, so what you lost in hotel business, hotel shares, you can gain. You can be even it out. You can have a balance it off by investing in different economic sectors. So certain risks you can diversify by investing in different businesses. So we say it, those are diversifiable risks. So the business risk can be diversified by investing in different business. The risk unique to hotel business can be diversified by you going into hospital, going into financial sector like banks, and going into transport business, conglomerates. You diversify risk, but there is a certain risk element that you can't diversify. That is the country level. If your economy is not doing well, okay, there is a report published recently. Our economic growth negative 16% in Q2. So they expected similar, maybe less than 5% economic growth in Q3 and 4 as well. So as a whole, economy is not doing well. So that part you can't diversify. So whether you invest in hotel or hospital, that there is a minimum risk element you can't diversify. You have to live with that. So we call that risk, we call it market risk. In any way, that risk is within the market, right? So understood, Sevandi? This is what I wanted to tell. So then so these are some of the exams you can be asked to explain what is the difference between unique risk and market risk. You should be able to explain that. Okay, so this is how we can explain in graphical kind of illustration. So that unique risk, so if you have we talked about two investments, hospitals and hotels. If you have so many number of, now x-axis you have 5, 10, 15 investments, right? When you have so many investment, you are diversifying your risk, okay, unique risk, okay. Then it will if you have one investment, like hotels, your risk is high. So as you go along, investment in different investment, your risk is coming down, but then thereafter your risk is at a fixed risk, that is anyway that you find in the market. That is, we call it market risk. Okay, so when you have a higher number of stocks investment, you are likely to diversify your risk. So in investment, another calculation that we do, we know exactly if you know exactly the return of each portfolio, and how much of composition that you have, you can calculate another thing called expected return. So let's say you have 1 million deposits going at 6%, and also you have another maybe 6% from 1 million investment in a bank, and if you invest in a finance company, you are getting a higher return. So you get a 10% in a finance company, right? So you have 2 million, you get 1 million, 50%, 5% rate, another 50%, 10%. Then what is your average expected return. So this is what this is how you calculate the expected return. Now this is the different way. That example given in a different method. Suppose you invest in 47% of your portfolio in Reliance Energy, another company, 53% in Grasin industry. The expected return on your Reliance Energy is 17%. Grasim is 14%. So what is the expected return on your portfolio? So total expected return, if your total in 0.47 gives 17%. 0.53 means 0.53 gives 14%, right? So when you simplify it and add it up, your total return comes to about 15.441. So that is something in between 17% and 14%. So if you have different risk element and different investment composition, you will get your expected return also strike a balance. Right, clear? So this is a simple calculation. These are some of the things that you need to know. Sorry. Right. So beta and unique risk. Beta in an investment portfolio, you can let's say there is anyway risk element, risk factor in the industry. Like I said earlier, anyway hotel business has a risk, right? Let's say entire hotel business risk is 1. So there are some hotels in Colombo. So you have foreign delegates coming in, so many other activities happening. Maybe foreign corporates do some functions, right? Anyway, there is a section in Chinese and foreign investors and big corporate CEOs working in Sri Lanka. They go to these hotels. So there is some business in Colombo, right? Cinnamon. So if you go to Hambantota, you don't have any business, right? Right. If the total risk is 1, so hotel in Hambantota has a higher risk, maybe 2 times of 1. So 2 times. So if it is a hotel in Colombo, that risk element is relatively low. Okay, so maybe 9.9%, right? So yes, industry is risk, but depending on where this hotel is, your industry can your company risk can be different, right? This is what this efficient frontier explains. Okay, return. We said no. There is a return investment risk. There is a positive relationship when you go along the curve. When the risk is high, return also going up. Okay, so when you go to the extreme right, risk is also high, return also high. It doesn't mean that that you get the best return by taking higher risk, but you can lose also, right? So that's the kind of a relationship that has positively correlation, right? So we try to with this concept, we try to come out with a model. Okay, so this is a security market line, similar concept graph. So anyway, that market return that everyone has to, depending on the market, you have to bear that risk. But risk-free return is the return that if you invest in a treasury bill or treasury bond, it's a government investment. You are going to get anyway the return. You are not going to lose any money. That's government. If you invest in a bond, If it is 5%, you are going to anyway, that is guaranteed. If you fixed deposit, no? Fixed deposits, why people deposit in a bank? Because they are very much secure as against depositing in a finance company, because finance company can go bust. Okay, likewise, no, more than the sometimes commercial bank deposits, if you invest in a risk-free like treasury bill or bond, which is government issuing investment products, then the risk is even low. But if you that along the line, your investment could be somewhere along the line, like RM, market return. That particular investment has a different risk return, risk element. We can denote as RM, right? So for you to calculate expected return, this R is expected return, so RF is risk-free return, so beta is the sensitivity unique risk, RM is risk, market risk, RF is risk-free return. This is how. So for any given security, if you know the risk-free return, you know how much you get from statistics, how much you get by investing in bonds. You have the data, government published data. The beta factor you should know, like I said, if it industry level, what is the risk, when compared to that, what your company risk element, right? So then what exactly that company's market return, right? So if you know these factors, you can calculate the expected return of the company, right? We have a example. Let's see how we are going to do it. So R is expected return on a security, R is risk-free rate, V is beta of the security, expected return of the market, right? So if trades, it trades on NSE. NSE is New York Stock Exchange, and its operations are based in the United States. Current yield on a US 10-year treasury is 2.5%, right? The average excess historical annual return for stocks is 7.5%. So beta of 1.5 times. So risk is more than the industry. So it is expected to calculate the expected return, right? Can we jumble few numbers and using that model like this, applying to this formula? Can you do a small quick calculation and see what R is? We are asking the R. Okay, we know the RF. RF is US Treasury 2.5%. We know the beta. Then you should calculate the R. Sevandi, Benuri, can you do it quickly? 2 minutes. Sevandi doing it, no? Yes or no? Yeah, they are right. Yeah, I'll give you little time, 1 minute. Just jumble with numbers and put in this formula, CAPM model. I hope you have pen and paper, book. If you are done, let me know. Srinidhi also there. I want you to do this sum. Okay. Just take this formula, apply this numbers, and get a answer. What I want is expected return. Did you get an answer? Difficult to get your talk. Right. Right. Let's see the answer. Right. So now you have this formula. We have tried to figure out what R is. RF. What is the RF? Risk-free return is 2.5%. You can straight away you can apply 2.5%, and beta is 1.25. Straight away you can apply. So it says average excess historical annual return for US stocks is 7.5%, right? Average excess historical return. So excess is in excess of risk free return, how much of return this particular investment get. So excess of risk free return. So you for this RM minus RF is straight away you can apply this 7.5%, because it says average excess historical. Excess is in excess of treasury bill rate, that is the market. So if it is market rate, the meaning is the market risk rate is 2.5 plus 7.5, 10%. So this gives the excess of 2.5%, 7.5%. So you have to straight away apply 7.5. So expected return would be risk-free return, beta factor, market return premium. So expected return is 2.5. So 1.5 times 7.5%, expected return is 11.9%. So then there are three forms of efficiencies in stock market. We call them, this is again a few times tested. I've shown in few question papers this question. So explain the efficient market theory. So you need to know this aspect as well. So anyway, from my section there is one question. So so these are some other things that you can look out for. So there's weak form of efficiency, semi-strong form of efficiency, and strong form of efficiency. So this is with regard to forecasting the future share market prices, right? Like now, few minutes ago we explained this. Now this stock markets, it was 100 rupees in April 2009. Now if you graphical form, if you forecast, it will not get the 1800 rupees somewhere in early 2011, but there is a method of calculating the trend, of taking all the historical data. There is a method to calculate the method to predict the future prices. For short period, that's okay, but it does not sometimes give the right prediction. So since it is not giving the right picture, we call it weak form of efficiency. This method has a weak form of efficiency when it comes to predicting the price of a share of a company. So then the next stage is semi-strong form of efficiency. So then you have the market prices. Yes, you have the historical data, plus then you can look at the annual reports of the company. So then you can go through the annual report financials, the disclosures, chairman statements, so what they are going to do in the next 1 year, the CEO statements, so many other sections, how do they perform against some of the competitors. You can compare and see this company, yes, there is a trend of achieving this, and also market also they explain in the annual report also they give macroeconomic situation. So if you see some favorable situation for this company, so you can see that aspect and predict the price. Someone who was in 2010 period, if they have predicted the demo being in the market leader in some of the vehicle sectors to do well and predict the prices to go up and buy shares, he or she going to win, right? So this kind of this have a kind of published information in the annual report plus the market data. So if you have both these things, then we call it and taking both these things into account and predicting prices, then we call it a semi form of efficiency. Then the super form of efficiency is strong form of efficiency, where you have the market, you have the access to market trends, and then you have the annual reports, and on top of that you have some kind of association with the CEO of the company. And so some of the things that not put in the annual report, so you get to know, maybe you've done a media person done an interview with the CEO, so here and there he just maybe happen to throw some of the strategies which is going to positively impact their financial performance. So without his knowledge he's telling, so he's maybe the media person asks him to explain what you're trying to do in the future. He will come out with future strategies which could line with which give rise to some other, which is likely to translate into which has more currency and translate into very good high value of performance in the future. So that information, now you have the data, annual report, published information, and also very private information to say that this show is going to do well. So with that you correctly predict it. So you have insider information, so it is going to be can be penalized if it is proven, but if you taking those all three situations into account and predict prices, there is a high probability that you predict that prices very accurately. So these are some of the ways that you predict prices according to a technical methodology. So if you are to predict the prices correctly, you need to use all three methods, right? So with that we'll move on to next video. So this is giant in finance industry,
his investing career,
Warren
has
Buffett.
achieved an
So let's see how he has invested in his portfolio. So to try to invest from a great investor all in the entire world, try to learn some of the tips so used in investment and stock market, right?
annual average return of 20.9% compared to the market's average return of 9.9%. Now, this may not sound like much, but if you take into account compound interest, Buffett's cumulative return was 2,404,748% compared to the market's 15,508%. This is all because of compound interest. And I won't be explaining compound interest in this video. What I will be talking about is Warren Buffett's current portfolio. We'll look at some of the stocks that made him rich and the stocks that he has picked to make him rich in the future. So let's just get straight on to Warren Buffett's largest position that he has in any stock, and that is Apple. Remember, this is the portfolio of the investing company that Warren Buffett manages, called Berkshire Hathaway. Apple makes up 23.77% of Berkshire's portfolio, and they own $47 billion worth of Apple stock. Now, I hope that you guys have heard of Apple before. Their products, they're found around the world, and arguably they are the most famous brand in the world. They're obviously the company that makes phones, but they don't just do this. They make laptops, watches, iPads. They have a service called iTunes. They make money through a range of key areas. But the main way they make money is through their iPhone sales. Now the question becomes, why did Warren Buffett make the decision to have Apple as his largest position by far in his stock portfolio? And Buffett has talked about why he loves Apple stock before. First, it's because of the amazing product that Apple deliver and the following that they have with their products. Consumers are hooked on Apple devices, and they're willing to pay a lot more for an Apple device compared to a device from another brand. And that all comes down to the quality of product and brand name. Buffett calls this Apple's competitive advantage or moat. Second would be the price. When Buffett bought Apple, they were selling at a great price compared to the value of the business. And even today, they're selling for a decent price. Their PE ratio is just 17. It's not as good as what it was when Buffett bought it, but the price is still nice. The second biggest stock in Buffett's portfolio is the largest bank in America, called Bank of America. So Bank of America makes up 12.39% of Buffett's overall portfolio, and the total value of this position is $24.7 billion. Bank of America, I don't really need to go into too much detail with this company. It's pretty obvious what they do. They do the typical things that most banks do: commercial banking, wealth management for individuals, investment banking, risk management, etc. Warren Buffett has been buying Bank of America stock for a good amount of time now. He bought back in 2011 when the bank was struggling after the financial crisis. But even to this day, Warren Buffett has been buying more Bank of America shares. And the main reason behind this is the price. Bank of America is just selling for a really good price at the moment and over the past couple of years. BAC at the time of making this video is selling for a price that is just under $30, and it's bringing in earnings of $2.80 per share. This gives it a PE ratio of just 10.5, which is ridiculously low compared to most stocks. On top of this, BAC pay a nice dividend of 72 cents, which gives it a yield of 2.44%. And this was one of the main reasons why Buffett bought into Bank of America, and that's for its extremely cheap price tag. Wells Fargo, a very similar position to that of Bank of America, comes in as Buffett's third biggest stock at 9.93% of his overall portfolio. Wells Fargo is a provider of banking, mortgage, investing, credit card, and financial services company. I also do not want to talk too much about the stock because the reason why Buffett bought into the stock is very similar to why he owns the Bank of America. He just bought it at a cheap price. Wells Fargo, on a pure earnings to price basis, is actually cheaper than that of Bank of America. If you look at its PE ratio, it's actually under 10, which is very low. Buffett actually owns a couple more bank stocks in his portfolio, and the main reason behind this is a cheap price compared to the value of the company. If you want to learn more about valuing a company, it's one of the things that I teach in my How to Invest course. Link, of course, to that is in the description. Let's move on though. One of Warren Buffett's greatest stock buys to this day is the stock Coca-Cola, and Buffett has said this, that he will never sell a share of Coca-Cola in his lifetime. So Warren Buffett bought Coca-Cola back in 1989, and to be honest, I have no idea how he managed to time this investment so well, but pretty much since he bought Coca-Cola, the stock has shot up like a rocket. I remember reading in a book about Warren Buffett about one of the reasons why he bought into Coca-Cola stock. This book may have been called The Snowball Effect, I believe. I can't really remember. Anyway, Buffett talked about how he used to collect soda lids as a kid. One of the things that he noticed was he was collecting way more Coca-Cola lids than any other soft drink. And this is just because consumers absolutely love the taste of Coca-Cola. There's just something about that flavor and that fizz that makes it the most popular drink in the world. Warren Buffett knew this was a major advantage that Coke had over other companies, and it's a big reason why he owns so much Coke stock. To this day, it's his fourth largest position at Berkshire Hathaway and makes up 9.4% of his overall portfolio. The value of his position is $18.7 billion. Funny fact, Buffett originally paid $2.50 for his Coke stock. Now the dividend for Coke is $1.56 per year. So his dividend now almost pays off his entire stock purchase price every year. One of the things that I talked about in my previous video is with investing, you want to pick an area that you are good at and then master all of those stocks in that area. One area that Buffett is good at is the banking and financial services area. This brings me on to Buffett's fifth largest position, which is American Express. American Express is a financial services company. These guys mainly do charge and credit card products, as well as travel-related services around the world. Now, it's quite funny the way Buffett has been buying into American Express. Basically, whenever American Express is in times of trouble, that's when Buffett, the hero, comes and buys some of their stock. He did this in 1963 when they needed capital, and in the 2008 financial crisis. Buffett is always greedy when everyone else is fearful, and this is one way he buys stocks for huge discounts. Bit of an unfortunate stock that Buffett has owned lately, which is Kraft Heinz, coming in at 5.33% of his portfolio, with Buffett's total position in Kraft being worth $10.6 billion. Now, those that have been following Kraft Heinz will know that this stock has been performing pretty bad over the past couple of years, especially recently where the stock fell by about 30% due to it reporting a loss in one of their quarters. Nevertheless, Buffett still owns it, and the nice thing about Kraft Heinz is it pays a dividend yield now based on their low price of almost 5%, making it one of the more higher paying dividend stocks in the USA market. The next four stocks I want to loop together because they're all banking and financial services stocks. I've already explained why Buffett has exposed his portfolio heavily to bank stocks. One reason being because he understands them very well. This is one of his competitive advantages as an investor, understanding this particular sector. Also, a lot of these stocks in the sector have been selling for very attractive prices as of late. And this is why Buffett has been snapping up a lot of bank stocks over the past year or two. Buffett's Berkshire Hathaway has 3.1% of their portfolio in US Bank Corp, 3% in JP Morgan, 2.2% in Moody's, and 2.05% in the Bank of New York Mellon. So now I just want to quickly go over the next four largest positions in Buffett's portfolio, and the rest of the stocks in the portfolio we'll leave out because they're all pretty small positions, and to be honest, I don't want to overload you with information. Let's just stick to the key stocks in Buffett's portfolio. Delta Airlines is Buffett's 11th largest stock position, coming in at 1.8% of his portfolio at Berkshire. I remember back in the day, Buffett said he would never invest in the airline industry. But as of recent times, Buffett has changed his mind, and now he owns a couple of airline stocks. The reason why he owns airlines now is because there's not many of them out there. There's only about 4 main airlines in the USA, so they have an oligopoly in the airline market. Also, airline stocks have been selling for attractive prices recently. For example, Delta sells for a PE of only 8.9. Stock 12 is Goldman Sachs at 1.8% of Berkshire's portfolio, and I've already explained why Buffett owns so many banking stocks. Let's not get more into it. Stock 13 is another airline company called Southwest, and yes, I also just explained why Buffett owns airlines. Southwest comes in at 1.4% of Buffett's portfolio. And the 14th biggest position Buffett is using to expose himself a little to the vehicle manufacturing industry. He's doing this through the stock General Motors, which he bought in early 2012. But he even recently has been buying more of the stock in the fourth quarter of 2018, Buffett increased his General Motors position by 37% in that last quarter. And those are 14 of Buffett's biggest stock positions as of 2019. The rest of the stocks in Buffett's portfolio are quite small positions, but I gotta say, there are some noticeable mentions in there. Berkshire has a position in Amazon, which they bought recently. They own Visa, they own MasterCard, they own Costco, a stock which made Charlie Munger quite wealthy. They own SiriusXM and Johnson & Johnson. But these stocks are very small positions in Buffett's overall portfolio, all under 1%. And you know, Buffett has bought all of these stocks with a very unique process. He looks at certain ratios in a stock. For example, a low PE ratio. He asks the question if management is top of the line. He looks at the moats of the business. He looks at the value of the business and a bunch more things. If you do want to learn more about that, there is a link to my course on how to invest like Warren Buffett in the description. But my thoughts have always been this: the best investors legally have to disclose the stocks that they invest in. So why not take advantage of this? Look at the stocks that they're buying, analyze the stocks that they own, and then make the decision if you want to own them too. Let's be honest, it's just a smarter way to invest.
Right. I think there are few tips from a great man in the world, richest person for some time, and he has given so many lessons for us. So one of the things, last thing that person who has done this program, he said, if you don't know where to invest, what you have to do is look at the people who have invested in a lucrative manner and who have done this and earn reputation and good returns. Look at those people and invest in those shares. That's what he said. So for more than that, Warren Buffett he has diversified the risk by, he has a larger share of their investment in what is the sector that he has invested mostly. Can one of you tell? What is the sector he has invested most? What is the sector he has invested most? I hope you have watched the video. Very interesting. What is the sector he has invested most? Banking, no? So he has invested in a bank and so many other banks. So because he knew the industry really well. So that's one reason why he has invested in banking. But he also said, sir, one industry he didn't want to invest. What is that industry? But later on, he invested for some other reason. What is that industry? So when you finish, you have the video, you can watch it again. That is airline industry. Okay, so I think that is the right decision that the airline industry is not doing. There is no tourists going movement, so that share is not doing well. But anyway, because of a monopoly in industry, airline industry, in certain companies like a few Delta and few other companies, he has invested. So I think we could learn. So main thing that we could learn from here is, yes, investment has been diversified into different. It is Apple, it is in the telecommunication and also smartphones, and then again banks. Then again, he has invested a lot in airlines. A small amount in airlines, then General Motors, Coca-Cola, and another very good investment he had. So he has diversified in his investment because there is he wanted to diversify that risk. But if you take America, USA, their market risk is relatively low when compared to Sri Lanka. But only thing that he has to make sure is, wherever possible, he diversified the risk, and that's what he wanted to have different shares in its investment. So I think so. I think next part we can take it up next week. So, are there any questions, Kibinuri and Sewandi? Any questions? And how do you did you learn anything from you? Any comments? Yeah, are you comfortable the way we are? Okay. I think you are. Yes, right. Okay, then see you next week. Be prepared to come prepared to do some calculations. Need to have a paper, a book, and a kind of a paper and pen. So, so until we meet next time, all the best. Thank you. Thank you.
Thank you.